30 points lower on GIFT Nifty as we speak.
Consolidated revenue has fallen by 1.1%.
Luxury retail team have redefined what luxury means.
The resistance is at about 19,280, same level we've put out, 38% retracement.
Exports, well, they moved a little bit higher on a sequential basis to around 13%.
Nifty holding on to 19,000 for now. The Sensex is absolutely flat.
We've got the private capex cycle, which hasn't really taken off in full steam as yet.
Industry is doing pretty well, recording between 15 to 18% growth.
We're in a good spot, fortunately, at the half-year level.
Nifty Banking Index is down close to about 170 points.
Our company's new product development are all in a very fast movement.
Well, it's a listless kind of a day. We're down about 60 points on the Nifty, and maybe we will see some action in the last 30 minutes like what we had yesterday. You're with us here on a fresh new edition of Closing Bell. We're coming to you from the CNBC TV 18 Motorola Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Rima here, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon. But you know, the reaction in the last 30 minutes has to be on the upside, not downside. Yesterday was on the downside. But it's down and out. There's selling pressure at higher levels. There's absolutely no doubt about it. We're just around the 19,000, approximately the 19,000 level. The Nifty Bank is down. Mid caps and small caps are just a little better. That's about it. You know, with 2 days of corrective action, if the market goes home this way, I think the legitimate question which will arise is, are last week's lows still in play? Not very far away. At least for the Nifty or the Bank Nifty. The bounce on the mid and small cap indices has been a little larger, so there's some more distance to cover. But for the Nifty, it's about 150 odd points or so. So we'll see whether that is the case. But there is selling pressure. It's not as if overnight, global cues were bad, equities were down. It was okay. It was quite okay. But even then, there is this pressure, which is very much there. So be mindful, trading especially. The skew seems to be selling the rallies, to be fading bounces and not the other way around, which is, of course, different from just about a month and a half ago. So around 19,000 into the last 60 minutes of trade today. Rima.
Hi, so last week's low, to be precise, was 18,837. So we're still about 180 points above that level. Today, Sun Pharma has been a big mover as it reported numbers. Stock has gained close to about 2.5%. Reliance Industries has been quite the rock this week. It's had one bad day, but today as well, it's moving up. On the losing side, Adani Enterprises, Adani Ports under pressure, and Vodafone Idea is seeing buying day after day. It's followed up yesterday's gain with another 10% up move. It's pulled up Indus Towers with itself. So maybe the street is really getting hopeful about that fundraise coming through before the end of this quarter, as the company indicated in the conference call. Birlasoft, one of the few IT companies where the numbers are actually a beat on revenues and on margins. Deal wins were strong. So on all parameters, Birlasoft numbers look good. And look at Kaynes Technology. You remember when we started trading out, the stock was down 7%, and it's pretty much erased all those losses and is trying to get back into the green. So yes, Q2 was a bit of a miss, but the company holding on to its margin guidance, is saying that margins will get back to that 15% in Q3, has provided that comfort.
You know, I think today the market's been all about individual stock reactions. It's finally been getting down deep in the trenches and looking at the earnings, and then going over whatever is working and what isn't. Speaking of what is working on a day like today, today's listing has done really well. Blue Jet Health is up about 16% right now, so pretty decent over there. And on the Adani Group, it's not just Adani Ports or Enterprises, not just the larger companies, but quite a few other Adani stocks are under pressure as well. Adani, Total, Gas, Energy, Green, most of them down between 2 to 3%. But Prashant, you know, I was just thinking, tonight, I think, is staying up night. It's not going to be about the announcement today. It's going to be about what he says in that press conference. So are you staying up?
No, absolutely no. If that causes something in markets, then maybe the day after.
Morning at 5, you'll track.
But not at all. Nigel, what are you tracking?
Definitely not the Fed tonight. but I'll be up in the morning, so 4:35 is when I log in and try to get the latest. But tonight for sure, no, and today's Karwa Chauth as well, so I've got a busy evening besides the Tata Steel numbers. So let's look at the Nifty Bank, and that's going to be the swing factor. Remember, it's been holding at around this 42,500 odd mark. It's bounced off that 42,450. We're 150 points away from those levels. So hopefully it doesn't get to that mark from a bullish perspective and break that mark, because that plays out weekly expiry as well. So the Nifty Bank is something you should be tracking. For the time being, it's moved to the low point of the day. How do you position yourself, though, in the final hour of trade? Mitesh joins us to help us out with exactly that. Mitesh, how do you read today's trading action? At higher levels, we are seeing some bit of selling, but we're not breaking that 18,950 level as well. Your trade on the Nifty and the Nifty Bank?
I think, the structure is weak and therefore every rally is seeing some supply at higher levels. But now is the time, when there are first signs on the hourly chart that we are oversold and we might try to fight against the supply pressure. So I think it will be a choppy few days ahead. The markets may, respect the previous lows, which for the Nifty is about 18,840. And on the upside, till it gets past 19,250, I don't think any reversal is coming. So broadly gives you a 400 point kind of range, and we are somewhere right now in the middle of the range. So avoiding the index, but yeah, that is the view. I think it will be choppy within that range. And for the Bank Nifty, the corresponding levels would be about 42,100 to about 43,400. So that's the broader range for the Bank Nifty, and I think we'll see again, some kind of choppy action for the next 2, 3, 4 sessions. So my idea is to let's see, in case we get closer to the earlier lows. And then if we see some sign of reversal, it will be a stronger one. So then, we'll attempt a long. Till then, I think index trading is slightly on the sidelines. And on the stock side, I have a buy on Godfrey Phillips. That's breaking into new highs. So keep a stop below 2,300 over here. Look for targets of around 2,450. And one sell call that's on Adani Ports, which I would recommend selling with a stop just above levels of 786 and a target of around 730 can be looked at.
Okay, got that. Thanks very much, Mitesh. We'll come back to you for some more trades a little later. GST numbers are coming in 1.72 lakh crores, so strong as ever. Those GST numbers for October looking good. Speaking of numbers, Nigel, how is Ambuja Cements?
Well, Ambuja Cements numbers were an operational miss, actually. And we've just got the volume numbers as well that came in there. But otherwise, you look at the top line, it was more than 100 crore miss out. But now, since we have the volume numbers, we know that it's coming at around 7.6 million tons odd. Most on the street were in that vicinity of around 7.85 to even 8 million tons odd. I think just one odd expectation was below that mark of, say, around 7.7. So the volume miss is the reason that these numbers go down as a bit of a miss. On the EBITDA front as well, there's a deeper miss out there. It's missed estimates by close to around 35 crores. And margins more or less in line because there's a miss on the top line which is further percolated down. But you'll say the net profit is better. Well, that's because of higher other income. So because of the higher other income, it appears that the net profit number is much better. Since we are seeing some bit of cooling off, well, that's evident in some of those costs as well. Now, in terms of the cash position, the consolidated cash position is close to around 11,700 crores, and they're talking about doubling their capacity. They also go on to say that the Sanghi Industries acquisition, that will be completed in the third quarter, and they're confident of doubling their capacity to around 140 million tons. However, just, a couple of their expansion plans, like the, Batapara 4 million ton clinker unit, and the Maratha 4 million ton clinker unit as well, it appears it's being delayed by close to around 2 quarters or thereabouts. So the numbers are, a miss. And also, if you look at it, well, the capacity expansion as well seems like it's pushed back a little bit. So that's what's disappointed the street. It explains why the stock is at the low point of the day. Prakash, what's your view on Ambuja Cements? If I look at UltraTech Cement in terms of execution, they have been par excellence. And if you look at the capacity that they've added is 70 million tons. And they're adding capacity at $70-80 per ton odd. If I take the acquisition cost of Ambuja and ACC together and look at their expansion as well, that's more than $140 per ton. So what's your view? Ambuja Cements at around 410, or would you stick to the larger boy?
So good afternoon, Nigel. So I think you're right. The kind of cost structure that Ambuja has inherited, and remember the whole salience in this was that the new management would be able to bring high levels of efficiency, scale up the business with better margins, and that's yet to happen. And then you've got the Sanghi acquisition that's probably come in and again put things into a little bit of a work in progress mode. So my sense is you'll have to give them at least 2 quarters for all of that to settle down, and then they'll probably be able to flex. Till then, Nigel, very importantly, cement is a very strong market share driven business. I mean, when the overall industry grows, people who have a good footprint, good distribution tie-ups, presence in the right geographies, they are the ones who benefit, right, with volume growth. And Ultratech is doing probably very well on all of those counts. So, and not only have they augmented capacity, they've been able to sell a lot better in terms of, the large players. So while Shree and Ambuja and all blink, I think it's Ultratech all the way would go to the, final this thing, top end market share game. But, Ambuja probably gives you a little bit of a chance to enter if you still feel that, from 400 to another 20-25% upside over the next 12 to 16 months is what it can clock. So I would not write it off completely, but probably see if this is the bottoming out phase to enter. But Ultratech, if you hold on, which we've been talking about, along with Dalmia as the mid-sized play and Ultratech on the large play, I think that combination still works very well.
Okay, let's now talk about Star Health, which has slipped in trade on the back of its Q2 numbers. Surbhi is here with the details. Surbhi, the company has also brought down their FY24 guidance.
That's right, so they have said that they won't be able to meet the combined ratio guidance for FY24. So let me take you through the internals first. So they have seen a gross written premium growth of 17% on a year-on-year basis, but the combined ratio was up 130 basis points, came in at 99.2%. Their claims ratio was also up 50 basis points at 68.7%. In the con call, management said that they will not be able to meet the combined ratio guidance for FY24 because of higher claims ratio. And also they said that they have taken price hikes in one of their key products and they look for further price hikes in some of their other products, which means that there will be more value growth rather than volume growth. Brokerages on that front are also negative because of this. Investec has downgraded it to a sell from a buy. They have a target price of 550 versus 660 previously. They said with slowing premium growth, the company will continuously be in an adjustment phase where they will cut their loss-making portfolio and also will take price hikes. And they think the guidance of 20% growth and 20% ROE appears to be aggressive. MK has also downgraded it to a sell from a buy. They have a target price of 510. They think the pressure on profitability in the medium term is because of the competitive environment in the retail health segment, both on the pricing and the commission front, and also the combination of higher claims is on account of older policy in the policy mix and higher claims severity. So on back of higher claims ratio is what the street is not liking.
Okay, got that, Surbhi. Thanks very much. So that's the story at Star Health. Not particularly healthy, just from a market standpoint in terms of expectations versus delivery. Prakash, hi, afternoon. Standalone health insurers, Star Health, how do you rank it? And what's your take looking at some of the issues that Surbhi was highlighting just now?
Good afternoon, Surbhi. So I heard the other Surbhi as well. I think she was bang on in terms of what the market feels. But, I differ a bit out there that I don't think claim ratios or higher claim ratios are such a big issue. If you compare that, the claim ratios have always been slightly higher given the fact that they have products which will be prone to claims coming through. If you compare it with last year's this thing, it's probably in the same 68% plus band, right? So what's changed for them, or what's kind of ailing and preventing the star from shining is that it's very difficult to reach out to the right kind of segments and grow at that pace at which a Bajaj Allianz could do, a Bajaj Finserv could do, or probably some of the bank led insurers would be able to do given their strong distribution network. So I think it's sheer business model differentiation that's coming in the way right now. You can't accord the same kind of a growth. The only advantage Star Health has is that it is far more nimble to launch products, to kind of innovate on some of the products. So it will take time for them to get the right mix, is my sense. It's a very good franchise. I wouldn't kind of, write it off just because it's kind of missed targets or missed the guidance. And they're being very real about it, right? So that's even very, very nice to understand. But it'll take some time for it to kind of be top-notch in terms of the return, the price volume action and all of that. But as a business, I think they're still evolving into that slot, and that might still take about 3-4 quarters for them. But yeah, I mean, it's definitely very clear why they're where they are.
REC is another stock which is on our radar, under pressure on the back of its Q2 numbers. Abhishek joins in with the fine print. Abhishek.
Well, REC has reported good set of numbers. The net interest margin is the highest, or improving for the first time in last 9 quarters. So take a look. Net interest margin has improved to 3.45% when compared to 3.28% sequentially. This has actually been driven by 17-quarter high in terms of YOY loan growth numbers as well. Spreads have also improved to 2.74% versus 2.59% in the previous quarter. Sanctions remain strong, growing at almost 15% quarter-on-quarter. Disbursements also very strong, growing at 133% YOY and about 22% quarter-on-quarter. The AUM growth of 20.2% YOY is perhaps the best or the highest in last 17 quarters, and sequential growth of 4.5% is also strong, given the fact that for last 3 quarters in a row, the AUM growth has been around 4 to 5% level on a sequential, that is quarter-on-quarter basis. In terms of PNL momentum, net interest income is up 12% quarter-on-quarter and a decline of 3.5% YOY. Provision write-back is there. However, PAT is up 38.3% YOY and about 27.4% quarter-on-quarter. So in terms of return ratios as well, the return on equity is the highest in last 32 quarters, coming in at 24.3% versus 20.6% YOY and about 20% sequentially. Asset quality, they continue to improve. The gross NPA ratio is perhaps the lowest that you are seeing in last 6 years or 23 quarters, coming in at 3.14% when compared to 3.28% in the previous quarter. Back to you.
Okay, thank you very much for that. REC is a stock which has gained 175% in the last 1 year and is pretty close to its all-time high levels. I think the all-time high level on REC is about 299 and the stock today is at 284. Prakash, there are a lot of tailwinds for PSUs, the power sector, and now good numbers. Would you latch on? Would you recommend a buy on REC at these levels?
Not really, Rima. These numbers are the reason why there was so much of anticipation being built around the PFC REC twins. Because we've seen the underlying sector do so well, and they are probably sitting at an advantageous point where cost of funds, the higher cost of funds hasn't impinged on any of their growth plans. But I think we are getting into election season of sorts. It's going to be very difficult to do a lot of things which you need for a financier in a sensitive sector like power to be much more efficient. It's a great order book which they're executing, and that's probably keeping them chugging along. But my sense is all of that good stuff is priced in, and these numbers actually will help it justify being at these valuations like never before. So let us spend some time at higher valuations in that band, and then you'll probably see a little bit of a new trigger leading to some sort of a price expectation, improved price expectation. But at this point, I think 280, 290 is a very good zone for it to consolidate.
Okay, got that, Prakash. It's good talking to you. Thank you very much for being with us. Always a pleasure. Look forward to more conversations as we go ahead. Right now, we do have to take a very, very quick break. We will come back on the other side and we'll be joined by Amit Gupta, Senior Vice President and Fund Manager at ICICI Securities PMS on the other side.
Okay, we're waiting for Reema to say something.
I think Reema's thinking about the next move in the market.
I was actually waiting for the director to cue, so I couldn't hear him
Why
cue.
not give it 2 seconds?
He's thinking about 19,000 Nifty. Is it going to hold or not?
Well, you're watching Closing Bell, and the Nifty is just about clutching on to the 19,000 mark, not giving it up just yet. We went briefly below that level at about 130, then we managed a recovery, but once again, we're seeing a bit of a slide there. 66 points lower on the Nifty, Sensex down 300 points. But the day belongs to many of the auto names which have released their October sales numbers. To talk more about what the numbers look like, Sonia joins in. Sonia.
Well, thanks a lot for that. It was a mixed bag this time around for the auto sector, at least the numbers that have come out so far. So let me talk about the good ones first, and then we'll move to the weaker ones. Maruti had a very good set of numbers this time. Total sales growth of 19.1%. coming in at 1.99 lakh units. Hero MotoCorp also had a very strong start to the festive season. They spoke about a sales growth of 26% year-on-year in the month of October, coming in at 5.74 lakh units, and talking about very strong trends in the festive season. Bajaj Auto also, echoed that same view, saying that they were pleasantly surprised to see how consumer has come back to the market, especially in some of the weaker pieces like the affordable segment. So the total sales for Bajaj Auto has gone up by 19% on a year-on-year basis. Eicher Motors as well, total commercial vehicle sales was up about 24%. So that was a list of good numbers. If you move on to the slightly weaker numbers, it's the tractor sales where there was weakness. That's also because of the, erratic monsoons that we had, as well as, Escorts pointing out as to how the demand trends are expected to improve. But in the month of October, because of the delayed monsoon season, it sort of on a year-on-year basis, it is not comparable. So total tractor sales down 8.9% year-on-year, M&M tractor sales down 3% year-on-year, and Tata Motors as well, the domestic sales growth was in low single digits, just a 6% growth year-on-year. So that was also on the weaker side. Back to you.
Okay, well, Sonia, thank you very much for that. So that's keenly watched sales numbers and if the momentum is continuing or not. Amit Gupta is now joining us. He's Senior VP and Fund Manager at ICICI Securities PMS. Amit, good to have you with us here. Good afternoon. Straight off the bat, we've seen a correction. It's still debatable whether the correction is behind us or, it's still in front of us. But in any case, we've seen some pullback. What is looking attractive to your mind? And, stuff that you like, where there was no margin of safety, which you wanted to buy, which has now become a little attractive. If you can go over some of those names. Go on.
Yeah. So I think some correction has already, come in. And there were some jitters because of elections also on the domestic front before we were moving into state elections. And we have seen that the Nifty always, tries to make the new highs and then goes into consolidation. And this time, because of this geopolitical crisis, it got the chance actually of some correction. I think it's a healthy point for the market. Just one point before moving into sectors. If you see the positive path of mid-cap and small caps right now, it has grown by actually 25%. And if you see the market cap of mid-cap, it has run up by 40%. Market cap of small cap, it had run up by close to 50%. And then this correction came in. So there were jitters that they were, a little stressed. But if you give some comfort from other data, if you see the losses in the corporates and you combine with the profits, because generally we look at the positive path and we see the incremental growth over that. But there are corporates where losses are reducing. So if you combine the losses, the net figure has grown by 80%, which is very substantial, actually much higher than the market cap they achieved. And this is where I think, and it has gone 80% in the small caps and 50% in mid caps. This is a reason, actually, I think in this correction, the market is throwing some opportunities. For example, hotels is one segment. I think PSU banks is another one. Telecom, that is another one where I think the numbers are going to be much better going ahead. The power space is the one where I think some correction is coming in. But going forward, we are very bullish because the peak power demand is rising in excess of 8% now. And I think this is very, very encouraging for the whole sector. So there are, things which are coming in. And if you see from the valuation perspective for the overall index, the 5-year average price to earning is somewhere close to 19,000 now. And 10-year average is somewhere close to 18,000. And I still remember in the last calendar year, 2022, when the correction had come from 18,000 to 15,200, that time Nifty had declined, had come closer to 10-year average price to earning. And we saw almost $14 billion of FI flows, despite the fact that dollar was moving up very sharply that time. So dollar index was touching almost 115. So dollar index is not 115 right now. Rather, it is close to 106. And crude is still around 85, 86, despite 20-25 days of the war of Hamas and Israel actually going on. So I think these are some comforting points for the Indian markets when somebody is looking for investment.
Amit, you said telecom throws up an opportunity. Here, would you go with stocks like a Vodafone Idea, Indus Stars, where there is a little more element of risk attached to it?
So they were not part of our portfolio, and we will not go in those stocks. We are very clear that if you see from the average revenue per user perspective, the best in the industry is coming from Bharti Airtel. It was around 190 before, and now it has crossed 200. So it has come almost to 203 in this quarter. And I think this is one major indicator which the market participants are looking at, because subscriber base in any case, it was coming in favor of Bharti and Reliance. We had already seen a 5G capex to some extent happening. Now they are talking about 6G also going forward. And the enterprise use of 5G, I think those applications uses are there going forward. So whether it is IoT or so many things going forward, so that will add on the revenue. And I think the free cash flows are going to come now. So in this quarter, you have seen, despite giving some spectrum, high cost spectrum charges, still they are coming out with a free cash flow, though it is little lower, around 2,500 crores. But we expect in the coming 2 years, 400 billion rupees of free cash flows are expected from Bharti Airtel, which is the key. And ARPUs are another key. If you see the mobile data revenue growth, it is also coming up. And they have added market share gain actually in the postpaid segment. So previously, I still remember, if you see the postpaid additions, it was around 4 lakh, but now it has come to 10 lakh. And this is, I think, a major factor for the growth of this. And that is where I think Bharti remains our top pick in the telecom space.
Okay, so you continue to like Bharti Airtel. Got that, Amit. Good afternoon. Take us through what what cues you picked up from L&T, and let's talk about the overall related space. I mean, infrastructure with L&T. I think every quarter it's the same story. Business is growing, order book is swelling, but their legacy orders continue to put dampen their margins. What do you think of the stock right now? And if you were to take more positions, more bets in the infrastructure space, then what would you look at?
So L&T remains our top pick. And I think if you see from this leader what's happening, their market share gain, we understand there are many things happening on the domestic front from the government. Those orders are increasing, but also from the GCC countries, because crude also plays around $85-90, which is comforting even for the Middle East countries. From there, its market share actually has now of the overall order book has grown to 35%. And I think this is where the company now is definitely doing good. In fact, generally, we talk about order book and then we talk about as a question mark about the execution and the cash flows. So we have seen that the cash flows are equally very robust, either from the government or from the Middle East. And along with this, we have seen that one of the critical indicator in the infrastructure is the working capital to sales. If you see the working capital to sales, which used to be 22% last year, surprisingly, very positive surprise, now it is almost touching 16%, 16.5%. So I think this is really positive from the operational leverage perspective when you are already seeing a robust order flow guidance. And this is where the actual profitability jumps in and the stock prices performs. And I am not surprised to see that they increase the buyback price also by almost 200 rupees. And this is the sort of momentum the stock is in. And I think this is where in any opportunity, because of the market decline, obviously healthy consolidation can happen for some more time. But in that, if you see the decline, I think it remains one of the top pick from the infra space, no doubt about that.
Hi, Amit. Good afternoon. What about Mamaearth? Any view out there?
So we are still, considering we have not looked into this. In fact, the whole, the consumer space for the time being, I think the problem is the mass segments, which are completely hit because of, the inflation and the rural segments which are coming up. I think urban consumption is one which is going to drive the segments now, and that we have to see. I think high-end consumer spending is picking up in India in various segments that we have to see going forward. I think possibly some hotels, maybe the bets that you can look at, or maybe premium housing. I think that is another one of the consumption thing. You can talk about investment, but from the consumption angle also, you can see, I think that is where the money is moving. You have seen that Hiranandani, they have clocked 1,100 crores within a week. You have seen that the hotels numbers are coming good. So that throws an opportunity in this decline, I think. So Lemon Tree from the consumption space remains our top pick. We believe that this is a small cap, 6,000-7,000 crore market cap, but had some debt in the book. And if you see the tariff rate increase, it is coming almost 16-17%. So if they continue to do so, because of the gap between demand and supply, so demand is coming around 5%, 6%, 10%, almost 9.7%, and the supply is around 5.2%. So there is a good gap, positive gap actually between demand and supply, which will keep on throwing a good profitability for these hotels, I think, going forward.
Okay, you continue to remain bullish on the hotels. For Mamaearth, the valuations actually are very, very high. Even if they do 100 crores this year, it's at 100 times. So let's see how that goes. But final question, Amit, before we let you go, there's plenty of debate whether or not you should be going to the large caps or the mid and the small caps. One would be that the valuations, well, of the mid and small caps, they've run a little ahead of themselves. But the other point is actually losses of some of these mid and small cap companies are coming down. What's your view?
Yeah, definitely. So losses actually, if you see it is coming down, look at the case of hotels only. So they were in losses in the time of pandemic. Now those losses are reducing because they are increasing the tariff rates, demand is good. And it is happening in some other sectors also. So that's where actually not only the positive PAT we need to see and the growth from there, which I said that it is around 25%. We also need to see the losses along with the profits and then see the growth for the corporates, which is really substantial for small caps, as I said, 80%, and mid caps, it is around 50%. So you can justify the valuations to some extent in some of these spaces. And I think this is where the key is. But you, as you said about large caps, they have not performed for the last 1 year or so now. And the large cap to GDP, large cap market cap to GDP, if you see, it used to be 100% in 2007. But right now it is much lower. It is, I think, around 65-70%, which throws some kind of opportunity for the overall Indian markets. Because if there is room in large caps, you cannot expect one-way fall in the mid and small caps. Because somewhere the large caps will start performing whenever the FI flows starts coming in, and then you will see the broader market also starts catching up. So this is positive that the large caps have kept a lot of juice in themselves, but they may not perform or very sharply in the very short term. I think they may take their own time because the outside world is in pain. The higher interest rates will have their own toll actually on the markets, and this is where the broader market will keep on participating despite the intermediate hiccups which we are seeing right now.
I mean, very briefly, do you have a view on contractors? I mean, EPC companies. I'm referring to one particular name. I'll tell you, Jaiprakash Associates. Now, they say turnarounds rarely turn, but sometimes they do, right? I don't know if you've looked at this company, its long trading history, but the recent news is, and again, people have been waiting for something to happen for a while. We don't know if it'll happen or not, but ICICI Bank, which is one of the lead bankers and the promoters of JP, seem to be, this came from NCLT itself, that they want to settle the matter outside of the NCLT process. And of course, I mean, there will be other hearings, but it's a long wait. It's been a long wait, but it's moved up some 35-40% recently. Would you even give it a look, in your opinion? Any thoughts?
So frankly, the returns can come in some of those stocks which are, heavily beaten down, but the kind of risk they have, it's a very difficult call to take in your portfolios. Because ultimately you have to see the return per unit of risk. From that perspective, if I have to take a call, I will go into the power space. As I said, I think power transmission, power generation, those kind of things one can look at, where return per unit of risk is much better than these companies.
Amit, we leave the conversation here for now. Thank you very much for joining in. But moving to the macros, the RBI governor yesterday said that India's growth is robust and that Q2 GDP will surprise on the upside. Meanwhile, we got a bunch of tax and core sector data which was released yesterday. Do the numbers square with the governor's confidence? Lata is here with the analysis. She's with us in the studio. Lata.
Well, for starters, what did the governor say? I quote, he says, looking at the early indicators, I can say the second quarter GDP in all probability will surprise on the upside. And on the same day, practically the same hour as he was talking, we got the core sector and the fiscal data for July, August, September, the GDP that he was referring to. So let's compare that. Now, if you looked at the gross tax revenues, there, the Q2 gross tax revenues of, overall, all tax put together, grew by 27.8%. I mean, that's huge. When nominal GDP is barely growing by 8-9%, that's a huge number. Q1, it grew only by 3.3%. But still, that brings the H1 to a 16.3% growth. Even better is corporate sector. Corporate sector, the Q-on-Q, the year-on-year growth for Q2 is 45.8% according to data released yesterday. It was minus 13.9 in Q1. And therefore, the H1 data is a very strong 20.2%. And finally, income tax is the best. Q2 over the previous Q2 is a growth of 51.2%, compares with just 11% growth in Q1. And therefore, the H1 is a solid 31% growth in income tax data. Now, you can, if you have such a good income tax data and such a good corporate sector data for Q2, it stands to reason that GDP should have grown well, because value added as well as consumption would both be fueled, one by income tax and one by corporate taxes growing. The other data which came in on October 31st, very strong, and that's core sector. Core sector in first quarter grew by 6% year on year, Q1 over Q1. But second quarter, it is 9.68, with some very strong numbers coming from coal, power, steel, etc. So again, that's another sector that shows that, which reflects in the GDP very strongly, has grown very well. So to come back to the governor's statement, the GDP forecast by the RBI itself is 6.5%, and that comes over a 7.8% in Q1. Now, I did a snap poll of economists. Most of them have upped their forecast, and they believe that the GDP, which will be announced on November 30th for July, August, September, will be better than RBI's forecast of 6.5. A lot of them are also revising their own forecast higher. The reasons they point out is the steaming growth in taxes reflects an economy where growth must be good. Second quarter numbers, many of them have been good, not all of them. And finally, US GDP surprising at 4.9%. Usually when the largest economy in the world grows so, in such a robust fashion, it does have a ripple effect even in economies, in the fourth largest economy like India.
Thank you, Lata, for that. The markets are fighting to keep that 19,000 mark on the Nifty, just below that. The mid-cap index too is now in the red, with the advanced decline ratio firmly in favor of the losing side. Get into a break. We'll come back and tell you what dealing rooms are saying in our segment East Street Chatter.
Fire. Welcome back. Well, if you look at the markets, we have moved lower, but actually it's not the Nifty Bank. There are a couple of other names actually that have moved lower. Pull up HCL Tech, that stock has moved to the low point of the day. In fact, pull up the tech index, the Nifty IT index, that's moved a little bit lower. So the Nifty Bank was down more than 200 points. Now it's down close to around 100 points. The tech pack has seen a bit of a knock. Pull up the tech pack. Also pull up stocks like, you have Coal India that's moved a little bit lower. Grasim actually has seen a sharp downtick in the last few minutes. So that explains why we're still holding at around the 19,000 odd mark. The Nifty Bank is playing out the weekly expiry, but it's the other constituents that have moved a little bit lower. But a good time to turn our attention to D-Street chatter. Nimesh joins us to tell us what's going on. Nimesh, what's the sense in terms of flows? At higher levels, we are seeing some supply.
Looks like, but again, while markets are days low, I guess the bit of nervousness is because of the FMC outcome tonight. But interestingly, the flows are not that bad. I mean, for the last couple of days, the feedback was the FIs were net sellers and turned out to be in the numbers as well. Today looks like, you may not see a very large sell figure from the FIs. In fact, there's going to be a small market at close basket buying as well at a leading FI desk. It's largely dominated in large cap names, but there is buying in some select stocks is what I understand. The good part is the broader markets are relatively showing strength. For the second day running, there is no big panic selling in the broader market. In fact, some stocks have outperformed in the broader markets. And within that, I guess real estate today stands out in terms of big moves in the real estate names. And on the other side, cement as a pack has seen some bit of profit booking. No specific reasons for those moves, but that's the general trend within sectors. So net, again, we've been trading in that very narrow range, but for a change today, the FIs are not large sellers is what I understand as far as flows are concerned.
Okay, then let's get to individual stocks. There's plenty going on there, right?
Absolutely. So the first stock on my list today is Zomato. For the last few days, some bit of selling pressure is clearly visible in that stock. Even in today's trade, the volumes are going to be higher, and I understand a large FI seller is putting pressure on that stock for the last many days. So that's the first one. The second stock is Transformers and Rectifiers. Been big mover in that mid-cap basket in the last many weeks now. Even in today's trade, there is strong buying traction, and the buzz is that maybe you'll see a large order win for the company very soon. So that's something to track there. The third stock is Gokaldas Exports. Post earnings, you've seen some bit of pressure in that stock as well. For the last couple of days, a large FI investor was a seller. Looks like the large part who was selling seems to be largely over in Gokaldas Exports in today's trade. And the last one is Apollo Hospital. This is going to be interesting. Been consolidating in a very narrow range, but now there is a very strong anticipation that maybe you will see some sort of corporate development soon. Remember, for the last many months now, there's been a lot of reports about a possible stake sell in Apollo 24/7. That's been long overdue. So maybe that is something which Street is anticipating in Apollo Hospitals.
Nimesh, thanks very much for that, and congratulations on that JSW Energy. And I had to, we must make a mention of it.
Thanks, Prashant.
And you're giving us a new news break today, so we'll track it.
Yeah, we need to track Apollo Hospital very closely now. Let's see. I mean, the numbers are still not out, so there is a strong anticipation for a possible monetization now.
Okay, all right. We'll take that on board. Thanks very much, Nimesh. Appreciate you getting us those details and individual stocks in focus. We'll bring in Mitesh now to talk to us about short-term trading ideas. What to buy or sell today for a reverse trade tomorrow. Mitesh, over to you.
So I'll go with the sell or STBT on Coal India. I think that's, after a good rally, has been sideways now, showing some signs of profit booking. So take a stop at about levels of 309 and a target of 302, 301 can be looked at. And then I have McDowell's or United Spirits on the buying side. It's near the day's high. The structure is positive here. So take a BTST here with a stop at 1033 for a target of 1060.
Thank you for that. IGL numbers flashing for you on your screen. EBITDA margin appears to be slightly ahead of the CNBC TV18 poll. Let's talk about JSPL. That's cracked quite hard in trade. Nigel, what's disappointed the street? You spoke about realizations in the morning, how they've missed the mark.
Well, that's right. A few big factors that played out for JSPL. One is the standalone EBITDA per ton, which is the India EBITDA per ton. We were working with a number of more than 12,000 rupees. It came in closer to around 11,000 rupees. The net debt as well moved up from around 6,800 to around 7,300 odd. So that was another factor. And the capex guidance. Earlier they've talked about around 24,000 crores odd over a few years span. Now they're talking about 31,000 crores. So those are the three big highlights: lower EBITDA per ton, higher debt, and a fear of too high capex. Citi, they have downgraded the stock to sell. They have cut the target price to 560 rupees. They see a risk to India's steel prices. And why is that? Because the difference between India's steel prices and Chinese steel prices has gone very, very high. So either Chinese steel prices move up from here, otherwise it'll be difficult to sustain this premium. Next up, CLSA, they're talking about spreads remaining flattish, even if there's an increase in realizations. And Morgan Stanley, they're expecting continued pressure on margins because input costs, namely coking coal cost, has gone up by more than $50 per ton. An interesting one coming in from Ambit as well. They are the lowest on the street with regard to target price. They're talking about 350 rupees per share. And they're saying that their target price implies 3.3 times EV upon EBITDA. They are fearing the similarity we saw 10 years or so ago when JSPL went ahead with that ambitious capex plan. At that time as well, inflation went up and the capex went out of the window. You know, it went totally much higher than what they were expecting. And investors, they say, would require courage, you know, to play this valuation discount that we talk about JSPL in comparison to the other names. So put all this together, that's one of the big losers.
All right. Thanks very much. That's a sharp cut, Nigel, about 8% or so. And we've been highlighting, you know, what's been happening here. Mayuresh Joshi is with us, Head of Equity Research at William O'Neill. Mayuresh, good to have you with us here. On JSPL, is there more to go on the downside in the coming days, or you think it'll stem here after the fall?
Afternoon, Prashant. I think for all the reasons that Nigel has enumerated, I think a large part of the accentuated fall that you've probably seen post numbers and the capex plans that they have announced should largely now start getting gestated in the price. Because to a large extent, what JSPL produces, the specialty steel, the realizations are a tad bit better than the normal peer comparison products that peer companies do. Obviously, I think the concern that Nigel flagged and what the street probably has is the burgeoning debt onto the books. And with the kind of increasing capex that they will undergo, obviously earnings might be a little bit subdued in the next few quarters to come. How the Chinese recovery possibly happens, what part of the overseas operations for JSPL contribute specifically on the operating front. All these factors are to be seen. A couple of quarters back, we were talking about strong deleveraging happening on the balance sheet. Now with increased capex, the kind of numbers that can probably come through as capacity start building up can be a little bit on the softer side. So yeah, I think a large part of the fall largely done with, but it largely now rests in terms of how earnings will largely.
Okay, all right. Mayuresh, request to stay with us. For the time being, we'll shift focus to some big global macro cues. Investors, they'll be awaiting Fed's decision on interest rates later today. According to the CME Fed Watch tool, the Fed Fund Future is suggesting more than 99% probability that the rates, they don't move. Let's hear out what Steve Leisman has to say.
Respondents to the CNBC Fed survey expect not just no additional hike this week, but no additional rate hikes at all. But what's interesting here is they have fully embraced this higher for longer mantra to the point where no rate cuts are now expected until the third quarter of 2024, as in don't hold your breath. Our Fed expectations chart from the survey shows 100% say leave rates unchanged, 5.29 is the peak rate, but 10.4 months, that's the average for how long the Fed will be on hold. And 57% of the respondents say that first cut doesn't come until September 2024. You'll remember this number, that date was as early as early next year. The 31 respondents divided on the outlook. 42% is the probability of a soft landing, 49% the probability of a recession, importantly below 50%. On the Fed rate outlook, you can see they've dialed back the cuts they had originally priced in. Now they're seeing about 75 basis points of cut by December 2024. It had been as much as 125 basis points of cuts. That's gone away. Diane Swak of KPMG writing in response to the survey, the Fed is likely to be stuck in a hawkish holding pattern as it weighs how much the rout in the bond market can dent the armor of consumers with so much savings still in their bank accounts earning interest. The inflation outlook shows the Fed is not forecast to hit its target even into 2025, with some thinking the Fed should be doing more to bring it down right now. Here are the numbers. 365, that's about where we are right now. That's where we end the year according to the average. 286 next year, down a bit, but not down much more to 2025. So the Fed still having work to do, which is where that higher for longer comes with. Growth, the slowdown that was going to hit the economy at any time this year, now forecast to hit next year. 0.73 is the one you want to look at right there. I will tell you, we had numbers like that for 2023. They did not come to pass. Respondents on average see the stock market ending the year about where it is now, but notching some gains next year and rising by about 13% by the end of 2025.
That's the big cue to track. The decision will be known at 11:30 p.m. India time tonight. The commentary will be key, and investors a bit on the sidelines ahead of that big decision. The Nifty is still below 19,000. Get into a break. We'll come back with more on the markets. 9 minutes left for market close.
Welcome back. Well, keep an eye on Tata Steel. The numbers will be due in a few hours from now. I've got a busy evening because of that one, but the street is sensing a bit of a disappointment. Maybe it's post JSPL's numbers because coking coal costs are going to go up for the third quarter. How do they deal with that is going to be important. And now there's a risk to pricing as well. So, Tata Steel has moved actually low. And HDFC Life, actually just pull up the intraday chart out there. That stock has taken a sharp dive. Keep in mind the Nifty Bank actually hasn't moved down that much. It's the other constituents like, you have HDFC Life that's moved lower, Tata Steel has moved lower, the IT stocks as well. IT index itself should come up for you on the screen. Mayuresh, what's your view on HDFC Life? That stock was doing quite well. Plenty of pessimism was built into the stock price and then it had a rally. But from the recent top again, it's down 10%.
To a large extent, Nigel, if you stack up all three life insurance companies, HDFC Life, ICICI Pru, SBI Life, obviously the hit because of budget changes in the last financial year is something that the management has taken in its stride. And therefore, the new products which will come through will be a little bit margin accretive as far as the product mix is concerned. Having said that, the VNB margins have held out pretty well. What really happens in terms of the premium growth is something to be seen. And that is going to be the crux of the deciding factor for all these stocks under consideration. However, if you stack up the entire OPEX element to the overall revenue, HDFC Life, ICICI Group has still one of the highest payouts, including commission payouts, and SBI Life probably stays at the lowest bracket. The kind of network also is of consideration, and therefore the bank insurance tie-ups with all three having very strong parentages. SBI Life a little bit on the higher side because of the sheer network that SBI has. And therefore, if you probably stack all these factors, VNB margins expected to be stable, relatively better for SBI Life, the product mix relatively better for SBI Life, and therefore the kind of provisioning that SBI Life has made, along with the lowest commission ratios and payouts as well, I think that probably might just stand out. But generally, I think we'll just wait and watch for the entire spaces.
Mayuresh, what is the internal view though? Is the market going to retest last week's lows, go even lower?
I think our take, Prashant, is that we will wait it out because the mechanism that we probably follow, we're waiting for a follow-through rate. So I think 18,800 becomes extremely critical. If that cracks, maybe it heads lower.
No, absolutely. So yeah, as we were saying when we started, I mean, it's not incrementally a lot more, but I think we were down about 60 points when we started. We are down, some more, 90 points or so. At one point, we were down 100. The low last week was 18,837. So we've gotten closer to that particular level by the end of today's session. Mayuresh, thank you very much for joining us. Good speaking with you. It's a pleasure. Let's just look at the Nifty Bank as well. Nifty Bank will end about 0.25% lower, a little better in terms of the performance vis-a-vis the Nifty. So it's a 0.25% cut on the Nifty Bank. It's a 0.5% cut nearly on the Nifty. And the small cap and mid cap indices, which were flat when we started, they're flat. I mean, slightly down the small cap index, but for all practical purposes, absolutely flat. The mid cap index is down about 0.33% as well. So there, I think it's still not that as bad. They lost the most, but they also bounced the most, especially the small cap part of the market. So that is something to be noted. On the Nifty, if you can just quickly look at the top losers, I think we've got Adani Enterprises, which is down 3.5%. SBI Life, we just talked about it, 2.5% lower. Coal India is down 2 1/3. Asian Paints is down 2%, and Tata Steel, another one we were talking about, is down 2% as well. So you got about 5 or 2% plus losers. There were two names with 2% plus gains as well on the Nifty. There's Sun Pharma, which reported numbers. Numbers seem to be a little better than expectations. And BPCL, which ends up about 2.25% as well. Rima.
Well, Blue Jet Healthcare, that was the new kid on the block today, had a fairly decent day. So it's ending up with a gain of close to about 19%. So pretty steady start. Apart from that, in terms of the big losers reacting to numbers, JSPL down nearly 8%. Keynes Technology ends with a cut of about 3.5%, but off from the session lows. REC also sees a bit of profit booking, though the numbers look pretty healthy. On the gaining side, you had Vodafone Idea, stock up close to about 8%. Indus Towers reacting favorably. Birlasoft strong beat on revenues and on margins, and the stock was higher in trade. And plus, other names like Amara Raja also reacting to the numbers. All in all, it's going to be a close below that 18,900 mark. 90 points gone on the Nifty. The Sensex lower by close to about 300 points. 0.5% gone. The advanced decline ratio ending well in favor of the losing side. What the street will be tracking from here on as we wrap out today's trading action will be numbers. So we still have numbers awaited from the likes of a Britannia. I think even Tata Steel is going to be reporting numbers, which will come out later. And then the big event will be the Fed decision at 11:30 p.m.
And we of course track that from early morning tomorrow. That is Thursday morning. Well. So that's a close, a disappointing one if you were hoping for a bit of a rebound or anything. But, looks like there has been more pain. So that 300-point bounce over last Friday and this Monday, all but nearly gone now with the cuts that we've seen over the last two sessions. It's a wrap on this edition of Closing Bell from all of us here. Goodbye. But don't go anywhere. Our special offering, Financial Quotient, comes up next in just a bit.